I mean, it should be pretty darn obvious that we are already walking through the reset. Boy, I remember when they didn't like me saying that because it wasn't obvious. It should be obvious to everybody now. It's just, there's just so much insanity that is going on. We still have 3.2 million Americans that are long-term unemployed, and benefits expired this past weekend. Nice, Labor Day weekend, and that's when the benefits expired. But a long-term unemployed person is somebody that's been unemployed for at least 6 months. And it's not really a very good position to be in because your skills, or at least the feeling is that you lose your skills. But these long-term unemployed represent 37.4% of all unemployed individuals. But we still have a major issue, as we hear, from labor force participation rates. And there are lots of reasons that they say, so now the big test is, now that they've taken the additional unemployment benefits away, is that going to make a difference in the labor force participation rate? So we'll have to pay attention to that and see what happens. But they were having challenges with that long before the pandemic hit. So as you can see, this is 2008, and you can see that it's been declining. It was just barely going up when we got this extra hit. So I find that really, really interesting. But beyond that, we hear so much about how people are paying more to get the people that are willing to work. Except when you measure it against inflation, well, there you go. Your real hourly earnings were down 1.2% for the full year ending July 2021. What? And so even though we've seen the employment and the wages increase, basically all they're looking to do right now is keep it stagnant. And they're negative because of inflation is running hotter. Now, what I want you to really keep in mind is that that was always the plan from the beginning. Wages never, ever, ever, or normal wages, average wages, never, ever, ever keep pace with inflation. But much of this inflation is based upon the prices and services from the corporations. So this is really what's enabled all of this income and wealth inequality that we talk about all the time. The average wage, 1971, $9,500, and the average family of 4 could live with one wage earner. Now in 2021, the average wage, $51,480. So you would say, well, I would much rather have $51,480 than $9,500, except that the dollar had a lot more value in 1971. And of course, this is the difference between Nixon taking us completely or removing gold as any level of anchor to create fiscal responsibility. So if you were paid just in gold, that would have been 225 ounces. Today, that same wage, average wage, only buys 28.07 ounces at Friday's spot close. But if you had not gotten a raise, but were just paid in the ounces of gold, that equals 412 over $412,000. Now, of course, in Biden's tax proposals, anybody earning less than $450 supposedly are not going to be impacted by it. And remember, these are always how things start. They kind of sneak in and then they get broader. But this really goes to show you how that nominal confusion hides the truth, because inflation is really just a currency devaluation. It is a slow devaluation if they can maintain it at that 2%. But it's a devaluation nevertheless. Make no mistake about it. But nominal confusion still hides the truth. That's its point. That was one of the things that those that created this whole fiat money system, they knew that. Not one man in a million understands inflation, but gold understands inflation, and gold protects you from that inflation. It is tested. Nothing else has been tested the way gold has been tested, and the way gold holders have been tested. We know this. But you know, one of the answers to what happened in 2008, because this is not disjointed. I know people like to think, oh, well, that was then, this is now. No, that was then. The system died. I said it at the time. I've said it ever since. It was put on life support, and the life support was debt and free money. So what did they do? They encouraged people to go back to school and take out those student loans. And then they turned all of those loans, all that debt, into financial products. Interesting. And sold these financial products back to Main Street. You are not getting paid for the risk if you're in any of these products. And don't assume that you're not, especially if you have institutional investors that are investing your money that you deposit into the 401ks, mutual funds, ETFs, pensions, etc. And we know that those payments have been deferred. And now borrowers have 4 more months without payments. Well, you know, a lot of what's happening with the Fed is to hide all of these truths, because if you knew this and you had money there, you might take that money out. Experts weigh in on the best way to spend that extra cash. Why? Because we are a consumer-driven economy. And in a consumer-driven economy, we must consume. Big increases in house prices presage substantial increases in measured housing inflation that will tend to consumer price measures up. Surging house prices expected to propel rent increases and the OER, the owner equivalent rent. So I go to you, this is what goes into the inflation numbers, which is one reason why we know they're not real. But I go to you and I say, okay, you own your house. If you had to rent your house from yourself, how much do you think you would charge yourself? But we've seen rents exploding. Do you think that actually goes into it? No, that's transitory. Food, energy, and real rents they don't have as big a weighting.